Hi, this is Jason, Chief Technical Analyst with Toro Alerts with your weekly market recap for the week ending October 14th. Saw a lot of volatility once again in the markets this week, so let's dive into the charts and take a look at what we're seeing. Starting out with the S&P 500, take a look at the SPY chart. We saw a massive move on Thursday to the upside after a huge gap down on the open on Thursday, and just a giant move up on the day on the S&P 500, and then ultimately opened up higher this morning on Friday, the October 14th, and then we saw a pretty aggressive sell-off after that. So a lot of big volatility moves over the last couple of days, and we've seen quite a few of those really over the last few weeks as well. But this last couple of days has been even quite a bit more extreme. So keeping a close eye on some multiple levels here to ultimately kind of determine where we're heading next. Taking a look at the SPY chart on our daily candlestick, we've got an anchored VWAP position sitting at about 354. So if we're sitting above those levels, I'm at least optimistic that maybe there's a potential bottom being put in at the moment. But if we do see some price action drop back below that 354 level and ultimately head lower from there, then I'll be taking a pretty bearish approach to the markets. But we are seeing some divergences on multiple indicators. We're seeing some divergences on the RSI, on the MACD, and some other different indicators where we're seeing some positive divergences there. So we could be getting some signals that we might see a possible bounce going into the end of the year. We also have some historical trends where going into the midterm election cycle, oftentimes we get a bounce coming up into that election cycle. And so we're going to want to watch these levels really closely. Again, that 354 level for the anchored VWAP on the daily is a really close level that I'm watching. If we want to hope for some bullish opportunities going into the end of the year. If we see it ultimately fall below those levels, then I think we've got to stay pretty bearish. We can also look at the S&P 500 chart on the SPX chart using the weekly candlestick and see that we're just slightly closed below that 200-week moving average. And I think that 200-week moving average is another really key line in the sand that we want to watch. If you're looking for some bullish opportunities, we want to see that price action get back above that 200-week moving average going into next week. But currently we're closed the week out just slightly below that 200-week moving average. And another divergence we're seeing when we take a look at some breadth indicators for the S&P 500, this top panel here is showing that we've got about 15.2% of the S&P 500 stocks that are above their 200-day moving average, and we've got about 11.6% that are above the 50-day moving average. And while those are fairly low numbers, we can see that we were actually quite a bit lower both at the June low and just recently around the September lows. We actually put in a new low on the S&P 500 that's almost a 2-year low. It was definitely a 52-week low just this week, but we can see that while the actual indice dropped to a new low, we can see that the breadth actually held up fairly well, and we're actually quite a bit above some breadth levels that we were at the previous lows. And so that's also a bit of a divergence there that could be indicating that we are at a bottom or getting close to a bottom. And then taking a look at our triple Qs, the Nasdaq, we've had similar price action on the Nasdaq, big move to the upside on Thursday, huge sell-off to finish the week out on Friday. But we are also seeing some divergences and some indicators on the Nasdaq as well. So we'd like to probably see price action get back up above that 269 level to get bullish on the triple Qs. If we continue to see price action, I would say below about the 260 level, then it's pretty hard to be anything other than bearish on the Nasdaq. And then taking a look at the Dow Jones Industrial Averages, we are actually sitting at a pretty key support level. We had also a big move on Thursday in the Dow Jones Industrial Average, and then a little bit less of a sell-off going into Friday, and it ultimately found support just above the 269 level on the DIA. That was also the support level that we hit at the June lows on the Dow Jones Industrial Averages. And so this chart's actually setting up to potentially be a little bit more bullish. And if we do hold that 269 level, then maybe we do see a bounce on the Dow Jones Industrial Averages. But we'll have to keep a close eye on that going into next week and see where we head from there. It also looks like we did get a brief ADX cross, so we'll see if that maintains. When the ADX green crosses the red, it means the buyers are in control, and so that could be telling us that we've got some momentum change in the Dow Jones Industrial Average coming as well. So definitely some close levels to watch going into next week. I think we'll get a good answer going into the following week where the Dow Jones Industrial Averages are heading from here. And then when we take a look at the Dow Jones Transportation Index, we can actually see, while it's been fairly sideways and choppy, volatile price action in the transports, we can see that we've actually closed slightly higher for 3 weeks in a row now, after putting in a bottom where we closed below that 200-week moving average. And so the transports are holding up relatively well while we continue to see selling pressure in the markets. And then when we take a look at our Russell 3000 chart, we are below that 200-week moving average, and it looks like we sat down just at the previous low, which was about 3 weeks ago on the Russell 3000, which is right around 2077, and we'll see if we can hold that level then and see price action move up from here going into next week and get back up above that 200-week moving average. And I think that'd be a pretty bullish indicator. If we continue to see price action below that 200-week, then I think we've got to stay bearish for the broader markets. And then we look at our Russell 1000 for our large caps. Similar chart here, we below the 200-week moving average right now, but it looks like it could be possibly trying to put in a bottom. We'd obviously want to see it get back above the 200-week moving average to get more bullish on the large caps, and currently that level's sitting at around 200 or so on the IWB. And then we look at our Russell 2000 or small caps, the IWM chart. We can actually see this one holding up pretty nicely. We've been holding support above this anchored VWAP position at 161.34, and we look to be trying to put in a pretty strong double bottom. So as long as we stay above that 161.34, I think that would also be another reason to potentially hope for a potential bullish rally going into the year end. If we see that 161.34 fail on the Russell 2000, then I think we've got to get pretty defensive and bearish in the markets. And then when we look at our growth versus value chart, we did have a period of time there after the June lows where we got a nice rally out of growth where it outperformed value, but then going into early August we started to see that rotate again, and now value has been outperforming the growth sector for quite a few weeks now. It looks like we've got about a couple months now where value has been outperforming growth since that last rally that we had from the June lows. And then taking a look at our sectors, this is the sectors that we track for the last 5 trading days. We can see at the top here that we've got consumer staples and healthcare and the financial sector are the only 3 positive sectors on the week. Financials are up 0.4%, healthcare is up 1%, and consumer staples are up 1.5%. So healthcare and consumer staples are typically more defensive sectors, but financials really aren't. That would be more of a risk-on sector. And we also started to see financials report this week, and so we'll want to keep a close eye on the financial sector next week. If that can maintain its positive price action while they're reporting, then that also might be a positive sign for the markets. And then when we drop down to the bottom here, we can see some of the worst performing sectors on the week. We have the cloud computing sector down over 10%, ARK Innovation Fund, and ARK Fintech down almost 9.5% each. We saw a pretty big drop in silver, down about 9%. That's oftentimes inversely correlated to the interest rates, and so it's not a huge surprise as we're starting to see interest rates spike once again. We also saw Cannabis and Semiconductors down about 8.2% each. And then jumping over to our oil barrel prices, we saw a pretty huge move the previous week, and oil had a big move all the way back up to the 50-week moving average, closing out just below or just above $94 per barrel. Then we saw a pretty big sell-off this week, so that 50-week moving average really acted as resistance, and we saw the price move back down almost to the $85 level. That $85 level is a pretty key area to watch and see if that can hold as support. If it does, then we'd be looking for some upside price action in oil going forward. If we do see that fail, then it would look like we'll be heading lower for our oil barrel prices, and the next target to the downside would be about 76.55 on our oil barrels. And then taking a look at our commodity index, CRB, we had a big move to the upside 2 weeks ago, got back up above the 50-week moving average, but then we did see commodities sell off along with oil this week. However, in the commodity space, we are sitting, looks like maybe just at or slightly below the 50-week moving average, but pretty close to it. Whereas when we look at the oil markets, we can see that it's quite a bit below, and it actually resisted off of that opportunity to get back up above the 50-week. So it looks like the commodity sector is outperforming the oil sector a little bit right now. And so we'll keep an eye on that next week and see if the commodity space continues to sell off and get below that 50-week moving average even further, or if we ultimately bounce off of that and head higher. And then taking a look at the all-world index, the VEU, global markets minus the United States, We're at a key area of support here where we actually fell down below it this week, but ultimately rallied back up and closed the week out right at that support, which is right around $44 on the VEU. That's a pretty major support area, as we saw ultimately the 2018 to 19 sell-off ultimately bottomed out at those levels, and this could be a pretty logical area for it to potentially rally off of from here. So if we see the VEU drop below that 44 and close below the 44 level going into next week, then that'd be a pretty bearish development for the global markets. But if we do see price action move up, that could suggest we might be in place for a possible rally. And then we take a look at our high yield corporate bond ETF. Looks like we had a pretty strong hammer candlestick put in on the week. So that also might be signifying a short-term bottom in the HYG, but as we can see longer term, it's still in a pretty significant decline and is at just about to the levels we were at on the HYG, the high-yield corporate bond ETF, back towards the bottom of the COVID crash. And so this is still a pretty bearish-looking chart longer term, and I think a big reason why I am looking for a bigger sell-off at some point, whether it happens in the fourth quarter or if it happens earlier in 2023. And then taking a look at our gold prices, we are sitting below the 200-week moving average. We tried to get back up after rates started rolling over. We saw gold have a brief rally, ultimately got up to our down channel trend line, found resistance there, and then started selling off. And so until we can get above this down channel trend line, I've got to stay bearish on gold. But if we do see a break in the gold prices above this down channel trend line, that could be a bullish signal that gold is finally reversing. It does look like we've got some more upside, I believe, in gold at some point, but it looks like we're still in a corrective phase, and gold has a pretty strong inverse correlation to interest rates, and so we'll likely see gold under pressure while the rates are rising. But I think there's a decent chance that while rates may stay high for a while, I think we're getting closer to the end of the rate hiking cycle, and once we hit that level, I think that'll likely be when gold reverses, and there'll be a good opportunity to get into the precious metal space. And then taking a look at silver, also below the 200-week moving average, currently sitting at $16.81 per ounce. We've found some pretty strong support around the 16 to 16.50 level, so we'll see if we can ultimately hold those levels or if we do head a little bit lower from here on silver. But ultimately, I will be looking for some upside opportunities in silver at some point, likely when those interest rate hikes stop, but we're not quite there yet. And at this point, at least, I'd probably be wanting to see price action get back up above the 200-week on silver, which currently sitting at about $19.30 per ounce. And then take a look at our interest rates. Our 2-year interest rates currently sitting at just below 4.5%, so we're continuing to see the 2-year just go up in a pretty amazing straight line, just about. There's obviously been a few little corrective moments, but this is probably one of the fastest accelerations we've seen in the 2-year interest rates, probably in all of recorded history. So it's been a big move up. It wasn't that long ago, if we look back to, say, beginning of 2001, or even in the beginning of 2002, we were only sitting at about less than 1%. We were at 0.8% at the beginning of 2022, and now we're sitting well above 4, almost at 4.5%. So just a historic rise on interest rates, and I think we still have a little bit more room to the upside on this, but I think we are getting closer to the top on rates. And then when we take a look at our 10-year, we are just above 4% now. We got up to 4%, and that's when we saw that sell-off, and we got almost all the way back to 3.5%, but then pretty quickly got right back up to the 4% mark. And I think we'll likely be heading a bit higher. The next upside target we're looking at is 4.28% on the 10-year, and we'll see if we can get any higher from there. But I do think we are starting to get fairly close to some tops in rates, but still might have a few more months left of some upward pressure in rates. But while there is a lot of talk of rates not going back down anytime soon, I don't think they'll be continuously raising rates going into next year, and so I think we'll probably see that in the interest rate prices in the fairly near term. And then take a look at our 30-year rates. We're sitting at just below 4% on this one. That's a pretty major line in the sand on the 30-year. We'll see if we can get above that or not, or if ultimately that ends up being the high water mark. If we do get above 4, then we'd be looking at probably around 4.5% for the next upside target on our 30-year rates. And then we continue to take a look at our yield curve. We've been talking about how it's been inverted for quite some time, and it's actually at pretty extreme negative readings. We're currently sitting at negative 0.476% on our 10s minus 2s, which is just a bit better than it's been over the last few weeks, but ultimately still in extremely negative territory. Also, one of the major charts that I've been looking at for quite some time that gives me some caution in the markets, and it's, I think, warning us all to probably be prepared for a bigger sell-off at some point in the near future. And then we take a look at our VIX. While we did see a lot of volatility this week, and we certainly stayed above 30 the whole week on the VIX, we ultimately saw the VIX come down over the last 3 days quite a bit. We had peaked out almost back up to 35 on the VIX, and ultimately had closed the week out just slightly above 32, 32.01. And so while there is still a lot of volatility in the markets, and I think a lot of fear and uncertainty at the moment, after these last 3 days at least, it looks like the VIX is heading lower for now. And so if we can see the VIX get back down below 30, see volatility settle down a bit, and if we do see the dollar roll over, then that could set us up for that possible rally. But we need to see those things happen first. And then take a look at our put-call ratio, currently sitting at just below 1, so we're actually in kind of a normalized range on the put-call ratio currently. We've had quite a few days and weeks where we've been extremely elevated, where there was a lot of put-buying protection in the markets. Currently it looks like a lot of that has been somewhat flushed out a bit. And then the DXY chart, really important chart we keep talking about, as the dollar going up has oftentimes put a lot of downward pressure on the markets, and a very strong inverse correlation in the crypto space as well. So the big question here is, do we get a rally higher in the dollar, or do we ultimately see it sell off? It looks like we might have some sort of an ABC correction going on right now. If we do get that, then that would mean that we'll see the dollar probably roll over next week and go a little bit lower. But we could obviously see it shoot up, and we might have actually already had this corrective phase, and we could be heading higher on the dollar. So the line in the sand on the dollar that I'm watching really closely would be about 115 on the DXY. If we see the dollar get back up to and above that 115 level, then I think that's going to correlate with the further selling in the markets. And if we do see the dollar roll over, or even just kind of pause and slow down, that could set us up for a possible bear market bounce. And we'll go ahead and finish it up with the Bitcoin chart, taking a look at where we're at on this one. We've seen some really tight price action for quite a few weeks now. It looks like we're getting into a bit of a squeeze on this that's likely going to result in some sort of a decent size move one way or the other. It's unclear which way we're going from here, but I think that dollar chart's going to be a really good clue as to where we go. So if that dollar slows down or rolls over and corrects a bit, then that could set us up for a decent move to the upside in Bitcoin, at least in the short term. But if we do see the dollar continue to rally, then we likely are going to see Bitcoin head lower from here. We do have this kind of down channel trend line we've been watching, where the Bitcoin price action's been staying in it pretty nicely, almost exclusively since about July, about mid to end of July of this year. And so that as we can see on this chart here, we're coming up against this up channel, or the down channel trend line on the top here, and then we can also see that we've been putting in what looks like a bit of a wedge pattern below here. And so we only got a couple more days with the candlesticks before we'll reach some sort of conclusion on this pattern, and we'll likely see some sort of a move, probably with a decent size move, one way or the other, once we break out of this pattern here. And so uncertain which way we're heading from here, but again, that dollar I think is going to be a really good indicator as to where we go next on Bitcoin. So thanks for tuning in this week, and we'll see you next time. Make sure to download the Toro Alerts app on the App Store. We've got one for stocks and one for crypto. And give this video a like and a share. And we'll see you next week.